Two people checked their 401k this morning. The first one did it quietly, said nothing. The second one? He's been sending voice notes to the whole office group chat. The loud one owns Nvidia. He's up 92% this year and he wants every single person in that office to know about it. AI is the future, he says. If you're not all in, you're the problem. The quiet one, that's you. You did the sensible thing years ago. Bought a boring SP 500 index fund. No stock picking. No CNBC. Just slow and steady. And you're also up just a little less. But here's the part nobody tells you: you own Nvidia too. A lot of it. You might own more Nvidia than 400 other companies in your fund combined. You just had no idea. My name is Root, and I've spent way too much time pulling apart the math behind what's actually happening in this market versus what people think is happening. If you want to understand why the sharpest investors alive are quietly stepping back while everyone else pops champagne at record highs, stick around. Today we're breaking down what's really going on, and why most people are about to get caught completely off guard. This isn't a story about whether the market is going to crash. Stocks crash, that's not news. This is a story about the fact that you own 7 stocks, and you don't know it yet. Let's start with the actual picture. As of right now, the SP 500 is sitting near all-time highs. The Nasdaq is at record levels. The Dow just pushed back above 50,000. If you've been quietly putting money into your retirement account every single month, you are genuinely winning. Congratulations. But here's what most people get wrong. They see the index going up and assume 500 American companies are all doing well. They're not. Out of those 500 companies, just 7 of them now make up roughly 35% of the entire index. 7. Nvidia, Microsoft, Apple, Alphabet, Amazon, Meta, Tesla. Add the next 3 biggest names and you're at nearly 38% of the SP 500 sitting inside just 10 stocks. Here's what that number actually means. Back in 2016, those same 7 stocks were about 12% of the index. Today they're 35%. That's almost tripled in under a decade. And in 2025, those 7 stocks were responsible for 42% of the entire index's total returns. So far this year, Nvidia alone has contributed about 1/5 of all the gains across the whole market. One stock. 1/5 of everything. So when I say you own 7 stocks and you don't know it yet, I'm not being dramatic, I'm being literal. Pull out your phone right now. Open your 401k. If your top holding says anything like Vanguard 500, Fidelity 500, any SP 500 index fund, or a target date retirement fund, congratulations, you are a heavy Nvidia shareholder. You didn't choose that. The math chose it for you while you were busy living your life. The system that was supposed to protect you quietly turned into a concentrated tech bet, and nobody sent you a memo. Okay, so we have a concentration problem. That alone isn't fatal, concentration only matters when something cracks. So the real question becomes, how expensive have these things actually gotten? And this is where the math starts screaming. There's a way economists measure how expensive the overall stock market is. You don't need the technical name. All you need to know is that this number tells you how many years of company earnings you have to buy in order to own $1 of stock. Historically, going back to 1880, that average sits around 17. Today, in May 2026, it's sitting at almost 40. The only time in 145 years of U.S. stock market history this number was higher was December 1999. You know, right before the dot-com bubble erased roughly 80% of its value over the next 2.5 years. Even in 1929, the year of the Great Crash that kicked off the Great Depression, this number was at 32. Today we're sitting at almost 40. We are statistically in the second most expensive stock market in American history. Let that land for a second. There's another way to measure this. You take the total value of every publicly traded U.S. stock and divide it by the size of the entire U.S. economy. Basically, are stocks worth more than the economy that produces them? Today that number is 231%. An all-time record. Before the 2000 crash it was 146%. Before 2008 it was 109%. Right now, US stocks are valued at more than twice the size of the entire US economy. That's like a single restaurant being worth more than the entire neighborhood it sits in. At some point, the math has to bend back toward reality. So why are stocks this expensive? One answer: AI. And here's where it gets genuinely insane. The entire bull case for this market rests on a single bet that artificial intelligence is going to deliver such massive productivity gains that it justifies paying record prices for essentially everything. Maybe it will. Honestly, maybe it will. But let's look at how much money is actually being spent on that bet. In 2026, just 4 companies, Microsoft, Google, Meta, and Amazon, are planning to spend roughly $725 billion on AI infrastructure. Data centers, Nvidia chips, cooling systems, electricity. The whole stack. That $725 billion is a 77% increase from last year, which itself was already a record. To put that in perspective, 4 companies are spending more in a single year than the entire annual GDP of Sweden. And that's just 1 year, they're planning to keep going. Now here's the thing about that spending. It's already starting to eat these companies' cash flow alive. Amazon is on track for negative free cash flow this year, somewhere between negative 17 and negative 28 billion depending on whose math you use. Amazon is now burning cash just to keep up with the AI race. Microsoft's CFO admitted that $25 billion of their spending this year is just chip and component price inflation. Not new capabilities, inflation. Meta got punished back in April when it raised its AI spending guidance and the stock dropped 6 to 9% in a single day. That was the first time investors meaningfully pushed back. But here's what nobody wants to talk about: the whole AI economy is starting to look like a snake eating its own tail. Stay with me on this one. Nvidia announced a $100 billion pledge to OpenAI. OpenAI then turned around and signed a $300 billion contract with Oracle for cloud computing. Oracle is now raising $45 billion to fund the infrastructure needed to deliver that contract. AMD gave OpenAI $34 billion in stock warrants. Nvidia is financing a company called CoreWeave. And what does CoreWeave do? It rents out Nvidia chips. These companies are essentially writing each other enormous checks and counting it as revenue. The circularity isn't even subtle anymore. And here's the actually wild number sitting at the center of all of this. OpenAI has committed to roughly $1.4 trillion in spending over the next 8 years. Their current annual revenue? About $13 billion. That's like signing a 30-year lease on a $4 million mansion while making $36,000 a year and just assuming you'll figure it out before the rent does. Now, in defense of the AI optimists, maybe they will figure it out. The cash flows at Microsoft, Google, and Amazon are real. These are not pets.com. But here's where the receipts get uncomfortable. MIT recently published a study looking at 300 real-world corporate AI deployments. The finding: 95% of the organizations studied are seeing zero return on their AI investments. Not low return, zero. So right now we're spending close to $1 trillion a year on a technology where 95 out of every 100 corporate deployments aren't generating measurable returns. Eventually the people writing those checks are going to want to see the receipts. And when they do, the math is going to have a conversation it doesn't want to have. Okay. Take a breath. Because we haven't even gotten to the macro yet, and the macro is where it gets dark. Here's the thing about expensive stocks: they're only justifiable if everything else is going right. So let's check on everything else. April inflation came in at 3.8% year over year, the highest level in almost 3 years. The Federal Reserve, which 6 months ago was expected to cut interest rates 3 or 4 times this year, has officially taken cuts off the table entirely. At their last meeting, the Fed voted to hold rates steady, and the vote was 8-4. The Fed publicly argued with itself for the first time since 1992. That's not a small thing. That is the closest thing to institutional chaos the Fed ever shows in public. And right now, the bond market is pricing in roughly a 37% chance of an interest rate hike by the end of the year. Not a cut, a hike. 6 months ago, we were all expecting cuts. Today, Wall Street is starting to bet on rate increases. That's a massive shift in a very short window. On top of that, Jerome Powell, who has been running the Fed since 2018, his term ended in May. He's been replaced by Kevin Warsh, who is widely seen as far more aggressive on inflation. So we now have a new sheriff, a stickier inflation problem, and a market priced for absolute perfection. Cool. Meanwhile, the 30-year Treasury yield just hit 5.19%, the highest level in roughly 19 years. When you can lend money to the US government and collect 5% with zero risk, paying 40 times earnings for a stock with all the risk in the world starts to look a little silly. Bond yields are gravity. And gravity just got a whole lot heavier. And then there's the debt. The federal deficit is on pace for $1.9 trillion this year. The national debt is over $38 trillion. The interest payment alone on that debt is now over $1 trillion a year. We are paying more in interest on our own debt than we spend on the entire United States military. Ray Dalio, who runs the largest hedge fund on the planet, recently called this an actual debt spiral. When the man with $150 billion under management uses the phrase debt spiral, you don't have to agree, but maybe write it down. Here's where I need to bring you back, because we still haven't gotten to the cockroaches. And I'm not joking, cockroaches. Let me explain. Remember 2007? Right before the housing crash, there were these small tremors. A subprime lender here. A weird hedge fund failure there. Nothing big enough to dominate the news for more than a day. But in retrospect, those were the warning shots. We have those same tremors happening right now. And nobody is paying attention. In the last 6 months, 3 random companies most people have never heard of have already collapsed and taken hundreds of millions in bank losses with them. A subprime auto lender filed for bankruptcy, and it turned out the executives had been pledging the same collateral to multiple lenders simultaneously. The Department of Justice charged them with fraud. JP Morgan ate a $170 million loss. Fifth Third Bank lost about $200 million from a single company nobody had heard of 1 week before. Then an auto parts company called First Brands collapsed under over $10 billion in debt. Turned out they'd been using off-balance sheet financing to hide exactly how leveraged they really were. Lenders thought the company was leveraged 5-to-1. Reality was 20-to-1. Several major lenders took losses of $500 million or more. Then 2 regional banks, Zions and Western Alliance, both disclosed bad loans tied to the same fund family. The whole regional bank index had its worst single day in over a year. And this is when Jamie Dimon, the CEO of JP Morgan, the biggest bank in America, said on camera, "When you see one cockroach, there are probably more." The CEO of the largest bank in the United States publicly compared the credit market to a cockroach infestation. That's a pretty bold metaphor coming from the guy whose entire job is to make the financial system feel calm. When he's using that language, that's worth paying attention to. So if you're keeping score, stocks at record valuations, concentration in 7 companies, AI spending that resembles a Ponzi diagram, inflation refusing to die, the Fed pivoting from cuts to potential hikes, government debt eating itself, and credit cracks showing up in places nobody was watching. So what are the smartest investors in the world actually doing? Because if it were just me, one person on YouTube yelling about valuations, you could safely ignore me. But it's not just me. Basically every legendary investor alive right now is positioned defensively. Let me run through them, because this part matters. Warren Buffett, the most famous investor of all time, just stepped down as CEO of Berkshire Hathaway. Berkshire is currently sitting on a record $397 billion in cash. That is more than 30% of their total assets just sitting idle. The highest percentage in at least 3 decades. At the May annual meeting, he told CNBC, "I don't see the ideal investing environment." Michael Burry, yes, the guy from The Big Short, the guy who actually shorted the 2007 housing market, recently said he's feeling like it's the last months of the 1999 to 2000 bubble. He's bought put options betting on a 30% decline in semiconductor stocks. His portfolio shows almost $1 billion in bets specifically against Palantir alone. Jeremy Grantham co-founded GMO and has called every major bubble of the last 50 years correctly. His statement in May was blunt: there will be blood in the streets. John Hussman manages a major fund and recently said, if there's any point in U.S. stock market history next to the peaks of 1929 and 2000 that deserves the label of speculative euphoria, now is that moment. His models imply a potential drop of 63%. Not 6%, 63%. Stanley Druckenmiller, the legendary hedge fund manager, quadrupled his stake in Alphabet in late 2025. 3 months later, in early 2026, he sold every single share. The entire position gone in 1 quarter. He also cut his Amazon stake by 94%. When this many investors who have built their entire careers on being early but right are all stepping back at the exact same moment, that is not a coincidence. That is a signal. And here's the part that should make you genuinely uncomfortable. In November, Bank of America surveyed professional money managers. 53% said yes, AI is a bubble. 20% net said companies are over-investing in AI, the first time that's been true since 2005. The price-to-book ratio of the S&P 500 hit a record 5.3, even higher than the dot-com peak. And Bank of America's chief strategist summed it up in 9 words: the top is a process. The bottom is a moment. Sit with that for a second. The top is a process, meaning you don't get a clean warning. The party drags on for months, sometimes years. When this many investors who have built their entire careers on being early but right are all stepping back at the exact same moment, that is not a coincidence. That is a signal. And here's the part that should make you genuinely uncomfortable. In November, Bank of America surveyed professional money managers. 53% said yes, AI is a bubble. 20% net said companies are over-investing in AI, the first time that's been true since 2005. The price-to-book ratio of the S&P 500 hit a record 5.3, even higher than the dot-com peak. And Bank of America's chief strategist summed it up in 9 words: the top is a process. The bottom is a moment. Sit with that for a second. The top is a process, meaning you don't get a clean warning. The party drags on for months, sometimes years. You own 7 stocks and you don't know it yet. If Nvidia drops 50%, your boring index fund drops right along with it. On top of that, Americans have now borrowed $1.3 trillion to buy stocks, the most in history, nearly 3 times the historical average. So when I say we're in the most leveraged, most concentrated, most expensive stock market in modern history, that's not a metaphor. That's just the number sitting in the data. And right now, half of all stock options trading volume is people buying lottery tickets that expire the same day they purchase them. We are absolutely gambling our way into a market top. So look, am I telling you to sell everything tomorrow? No. Genuinely, no. Timing the exact top is a loser's game. Plenty of smart bears have been bearish since 2023 and missed a 130% rally in the Nasdaq. Paul Tudor Jones, who is no slouch, said in May that we might still have 2 more years of upside before any real reckoning happens. Markets stay irrational longer than you stay liquid. That is an actual rule. But what you can do right now is be brutally honest with yourself about what you actually own. If your portfolio is 100% S&P 500, you are not diversified. You are concentrated in 7 AI stocks with a 493 company hedge decoration around the edges. If you're invested on margin, you are betting the music keeps playing, and the music is louder right now than it's been in decades. If your strategy is I'll just sell when things start to look bad, please understand, you won't. Neuroscience is brutal on this one. People do not sell into euphoria. They buy into it. People do not buy into fear. They sell into it. Your future self is not going to be smarter than your current self. Your future self is going to be exactly as scared as everyone else when the moment comes. What you can do is the boring stuff. Look at your actual allocation. If you've drifted way overweight tech, consider rebalancing. Consider equal weight SP funds. Consider international exposure. Consider bonds. Consider cash. Cash currently pays you almost 4% risk-free for doing absolutely nothing. Warren Buffett is sitting on $397 billion of it right now. You're allowed to hold a little yourself. Don't try to be a hero. Don't try to nail the top. Just don't be the last one standing when the music stops. Because the top is a process and the bottom is a moment. Right now the process is still playing out. The market is still climbing. Your coworker is still winning. The headlines are still optimistic. The vibes are genuinely still good. That is exactly what the late stage of every major bubble in history has looked like. That's what 1929 looked like in early 1929. That's what 1999 looked like in early 1999. That's what 2007 looked like in early 2007. You don't get to choose whether the moment comes. You only get to choose whether you're holding the bag when it does. And right now, whether you know it or not, you're holding 7 of them. Anyway, that's where we are. If you got something out of this, hit the like button, hit subscribe, and drop in the comments what your top 3 401k holdings are. I'll bet you find at least one of those 7 stocks sitting in there. Just to be clear, I'm not a financial advisor. This is for educational purposes only.